Before we start, I would like to acknowledge that a lot of people have joined us today from various corners of the world. And on behalf of QuantInsti, I would like to tell you that we sincerely hope that each and every one of you is in a safe and secure environment and taking care of yourselves at the best of your abilities. We understand that it is extremely difficult to deal with such uncertainty. We appreciate how you are willing to use this time in the most productive manner and to help you with your learning goals and to help you succeed. We will do everything we can from our end because let me assure you that we all are in this together. Coming back to the webinar, we'll be focusing through the quantitative analysis on how pandemics impact financial markets. The session will be headed by Mr. Ishan Shah and hosted by me, Aditya Gupta. A little bit about us. I am Aditya Gupta, and professionally, I've been a trader for the past 4 years. I've had the opportunity to trade derivatives of multiple asset classes on various exchanges around the world. And I've also worked in order to advocate the importance of financial literacy in our country. And now at Quantra, I help future algo traders start their journey in the algo trading domain the right way. And I'm extremely happy to introduce Mr. Ishan Shah to our audience today. Mr. Ishan Shah is the AVP at QuantInsti and heads the content and research department at Quantra. Mr. Ishan has been the pillar of contribution in the success of some huge financial institutions such as Barclays and Bank of America, Merrill Lynch. And he was able to do all of this because of his rich experience across various asset classes in the financial markets. About QuantInsti, as a team, we are a group of traders, coders, and analysts who are passionate about teaching and sharing our experience to help create full-fledged ecosystem for algorithmic trading. QuantInsti was started by iReach, which is currently one of the largest high-frequency trading firms in India. At QuantInsti, we are driven by a mission to bridge the gap between theory and practice in algo trading. And we do this by extending plethora of offerings to all the soon-to-be algo traders and professional algo traders out there. So the focus remains balanced between learning and implementing. And finally, as we strive to offer the best services and the tools to achieve our mission, which I talked about, our vision is that we aspire to see retail investors take advantage of quant and algorithmic trading by making technology simple so our learners can upskill themselves accordingly. Our products, currently we offer 3 fantastic products. Firstly, we have Quantra, which is a platform where learners enroll themselves for self-paced courses. These courses focus upon various segments of the market, depending upon the learning goal for each of the learner. Secondly, we have EPAT, which is a flagship program of QuantInsti. EPAT stands for Executive Program for Algorithmic Trading. And it is an online classroom training for serious learners in the domain of algorithmic trading. Learners who aim to dive into the world of algo trading in order to get a better role or to start their own trading business can enroll in this extensive program, which has content for over 300 hours and which can be completed within 6 months. Last, but certainly not the least, I would like to tell you about Blueshift, a platform where learners can implement their learnings of algo trading to carry out paper trading or live trading. Blueshift has over 10 years of data for equity and forex markets. And coming back to its best feature, Blueshift offers an institutional class infrastructure free of cost at each learner's disposal for investment research, fast backtesting, and as said before, algorithmic trading itself. So in a nutshell, We are aiming to be the one-stop shop for all your needs with regards to algorithmic trading. Now, without any further ado, I would request Mr. Ishan to take over and help all of us understand how pandemics have impacted financial markets in the past and what we can expect to experience in the future.
Yep. Thank you, Aditya, for a kind introduction. So, and hello all, and welcome to this session on the impact of pandemics on financial markets. So yeah, as we are under a very uncertain environment, which is also reflected in the stock markets, because stock market does not like uncertainty. So let us understand how this is impacting our financial markets. So that's the first thing. But before that, let's see what are the various news which are everywhere around us, which are all negative, and or maybe even more negative, which might be coming in future. So we all come across this kind of news, which is my business is closed, or everywhere none of the shops are open, manufacturing plants are shut down, no one is producing anything, and therefore they don't have salaries to pay, so they are cutting out on jobs, a lot of unemployment, there is a disruption in supply chain, and no essentials people are holding, say like a toilet papers, so we don't have daily essentials with us, and and the number of cases are rising, infections are rising, and which is causing tremendous pressure on healthcare system. So for developed markets, still they have a very better class of healthcare system, but emerging markets such as India does not have that kind of healthcare system to support. So we are going to see a huge pressure on that, and many more. So so one of the obvious question which comes to our mind, and is like when this things will end, and when we can expect some good news. So we'll understand, analyze all those stuff in this webinar. So let us first understand the impact on financial markets. So I have used the Python freely available APIs and code to create all the charts. So for illustration purpose, all these codes are available on our GitHub channel. So for example, let me walk you through this piece of code which is used to plot the daily percentage change for S&P 500. So I quickly walk you through this small snippet of code. So those who are not familiar with coding can just follow my command, and those who are like pretty much savvy and are pretty much good in coding can actually refer to the detailed notebook which is also available along with this, and which has all the graphs and analytics which are used in this webinar. So first of all, everyone just focus on this, which is how to plot the daily percentage change. So so I used pandas data reader to fetch the prices of S&P 500. So for that we have a method in pandas data reader, which is get underscore data underscore Yahoo, and to that we have passed two arguments. First is the ticker. So the ticker for S&P 500 in Yahoo Finance is cap GSPC. So that is what we have mentioned, and then the date from which I want the data for. So so if you do a little bit of search on internet, then you will discover like the 17th November was the first date when the first case of coronavirus was identified. So let us see how the performance for S&P 500 has been from that date. So therefore is 17th November. And when I run this, I get this data set. So I just printed the first 5 rows using the head function, and I just getting this 6 columns, which is open, high, low, close, volume, and adjusted close. Now, since we are interested in daily percentage change, I will calculate percentage change by using PCT underscore change function of the Python, and it is called on the close column. So I'll get daily percentage change. So for example, if S&P 500 is changing from 100 to 102, then I will have a value of 0.2 in this data frame in this series. And it's very simple to plot in Python. Just pass the name of the series, which is data underscore PC, and call the function plot, and it will plot the data series. So this is how the daily returns of S&P 500 looks like. And it's actually slightly smaller and not that good. So what I've done is I just added a grid, increased the size of this chart, and just added a vertical line. And this vertical line is of say 3rd of Jan, and it can be on any date, so it helps us to segregate the graph. So this was a quick introduction of how the Python code is structured. The details of all the charts which are used in this webinar are available on GitHub, and we'll be sharing the link of that with you. So now let me jump back to the presentation. So in this presentation, as you can see, so we learned about S&P 500. Similarly, I have plotted for crude oil, gold, and TLT, which is 20 years treasury in US markets. So I plotted the daily percentage change for each of them. So it's very easy to cite the difference. So the blue line is the date on which the first case was identified, and the red line is the date on which WHO declared public health emergency. So as we can see, the volatility or the change in the price on daily basis for S&P 500 was very close to say zero. And as we can see, when WHO declared emergency, just some days after that, the volatility has, or the change in the daily percentage has sharply changed, and it's ranging from say 5 to 10% daily movements in S&P 500. And it's not only in S&P 500, which is like a barometer for US market, it is also seen in say crude oil, gold, and TLT, which is 20 years treasury bonds of US market. So, so yeah, something is not well, which is Corona is there, and therefore which is making financial markets jittery, and which is what is clearly seen. So another way to look at the same thing, so this is on a daily percentage, but someone would like to say, okay, there's a lot of down movements and there are a lot of up movements also. So how do I actually assess how would I move from point A to point B? So for that, I have plotted the cumulative returns. So I just taken some days back from the first case, from that to say yesterday, how the S&P 500 and all the various things have performed. So as you can see, the red is for the crude oil, and it is the worst impacted. Like it's almost down like it seems like a 60% fall from the top, which is seen in the crude oil, and so is S&P 500, which is this blue line is impacted. But gold is not bit impacted. So there'll be a lot of questions in mind of you is should I buy gold in my portfolio? Is it like a good hedge in this uncertain times? Looking at this graph, it does seem like that, but I'm not concluding anything right now. That park that question for a while now. And US Treasury are also had some downfalls, but has quickly recovered. So another way in which you can have a better view of this graph is through a drawdown plots. So for everyone understanding, drawdown measures the fall from peak on any particular time period in time. So for example, S&P 500 would have made a peak around this time period around February, and from there on it has fallen almost close to 33%, which is at the 33 to 34%, which is at the maximum level, and then it has recovered now. So similarly, crude oil has fallen almost 67%, and the fall has been very steep. Everything just happened in a matter of say a month, like a March, Feb and March month. And gold has seen some fall, but it has also recovered, and there are some few sharp spikes which we can see for gold, and it has recovered. And similarly for TLT. So again, this is really helpful to understand how much asset class can fall, but still someone would like to understand, okay, these are four different instruments, but what is the relationship between this four of them? So for that purpose, we do a scatter plot. So scatter plot helps us to understand the relationship between these instruments which we have. So so this is S&P 500 with respect to TLT, which is this red scatter plot. And as you can see, it has a negative relationship. And as we all know, when there is a crisis like this, like a coronavirus, there is expected like economy will slow down, and therefore Fed and all agencies steps in and reduces the rate. So reduction in rates results in a so there's an inverse relationship between the rates and price. So a reduction in rate results in a uh, increase in price. So therefore we see this negative relationship. So S&P 500 will be falling, but TLT will be rising. But still, this is very less data points to conclude anything. For gold, we see there is no relationship with S&P 500 because these dots are spread across this plot, as we can see. And similarly, for crude and S&P, it seems like this far points are negatively correlated, but these near points are positively correlated. So we cannot conclude anything for crude. So so answer is so question is, how do we actually establish the relationship between this, which will help us to create a portfolio which will be good in terms of pandemics. So this is one thing. And other thing is, so this we are talking about the like S&P 500 and global commodities and bond market, but how has individual sector within this US market has performed. So as you can see, the pharma is something, pharma and technology are something which are relatively less impacted. So which is technology is this orange line, which you can see, it's at the very top, and which is followed by pharma,
Hi,
which is this blue line.
Hi, Ishan. I'm so sorry to disturb you. We have been getting a lot of requests for the presentation to be made in full screen. I humbly request you if you could make the same, do the same. And
Yeah.
second, we are getting a lot of requests for TLT. Is it possible for to have a little bit explanation on what is TLT? Thank you so much,
Okay.
Ishan.
Yeah. Sure. Thank you, Aditya. So let me make it a full screen, and before that, let me explain you what is TLT. So we have this treasury bonds in US. So TLT is a 20-year treasury bond. As you can see on my screen, it's an index by iShares Barclays, and it typically holds treasury bond which are in maturity of 20 years, 20 plus years. So that is TLT. Okay, let me quickly check any other questions. So I'll put the PPT in full screen mode. Uh, and there's another question that says multivariate linear regression. So that's we'll just talk upon. And there is another question which says, when do we use the scatter plot for? So scatter plot is typically used when you want to establish a relationship between two different components. So in this case, we want to establish how is, say, crude oil related to S&P 500, or how is gold related to S&P 500. And the application of this is, so if two instruments are, say, highly correlated, for example, crude oil and say S&P 500, then whether you hold crude oil or S&P 500, when one falls, other will also fall, and which is not good for your portfolio. But if something is negatively correlated to your say portfolio, in that case, it's very good to have in your portfolio, because if one will fall, then other will take care of that fall and will overall less impact your portfolio. And other is where did you download the crude oil data for? So crude oil data is available from Yahoo Finance. So you can use this, which is Pandas data reader, to get the crude oil data. Just put in the appropriate ticker, which is CL equal to F, to get the crude oil data for. And for uh, for API in Java, so I'm not typically aware of any data fetching API in Java, but Python is really easy to use. Why don't you use Python, and then you can easily port the data in Java and based on your own system. Okay, so let me present. So in the full screen mode, okay, so now I'm in full screen. Wait, let me just, okay. Just hold on, let me, yeah, now it's fine. So yeah, so I'm in full screen. I hope now everyone is able to see my screen correct clearly. So okay, so this is how S&P find a relationship with these three components. And now we are talking about the sectoral performance. So overall, all the sectors are in same direction, which is in negative direction, but the relative magnitude of the fall is different. So for example, pharma and technology are relatively less impacted. As you can see, this orange line is for the technology, and the blue line is for the pharma, and this pink line is for the energy, which is the most impacted. And we also know crude has fallen quite a lot. So as you can see here, the crude has fallen almost like a 67%, and which is making this energy sector impact more. And another interesting thing is this green line, which indicates financials, has also fallen most. So the reason for that is whenever the economy slows down, there are a lot of defaults in the loan which is expected, which will result in rise of non-performing assets for a bank, and eventually they will take a hit on their P&L because if a lot of NPAs rise, then it becomes difficult for a bank to survive. So one classic example of this in Indian market is Yes Bank. So, so therefore, NPAs become a key metrics, and in this economic downturn because of lockdown and other stuff, the chances of default rises, and therefore financial sectors are bearing the brunt of it. So a lot of you guys would have questions. Then in that case, should I just ignore financials and load up on say technology and pharma, and what should my portfolio look like? So along with this, we all have this questions, which is when will this crisis end? How will it end? Like, will there be a vaccine, or how things will shape up? Will markets fall more from here, or how it will move? So will it move in say some days down, some days up? I don't know. Let's figure it out. And there is a lot of people, especially during my like this. Telephone with my like uncles and say my grandfather. A lot of them just ask like gold is better, let's buy gold. All It's always a safe haven in this kind of crisis, so we'll also figure that out. And other is like it is so contagious, everyone will get infected. Will world end? And even there was one question somewhere like, will Sensex go to zero? So people are actually making going quite crazy about this virus. And the last is more relevant is how earnings will be impacted and which sector will be impacted the most. So, and thanks Aditya at the start for asking this relevant question. So I hope these questions are in line with what you have in mind while attending this webinar. So let's see how to answer this question. So I don't have any crystal ball to give you all these answers, but what we'll do is we'll look at past pandemics and then take cues from it to say to answer the questions which are listed on the screen or which you might have and not on the screen. So the best way is to look at the past pandemics. Okay, so far any questions? Anyone else? Okay, so there are a couple of questions. What is basic material? So Akshay, I'll just share some links with you after this session. So in US markets, there are these different sectors, and I'll share you the link how the sectors are, which how they are created, and other stuff. Uh, So there's a very interesting question from Mahid. He says, was there any correlation between fall of Yes Bank and COVID-19? So the good part about this webinar is I will share all the codes with you after this webinar. And the only thing which you have to do is all your hypotheses or all the questions which you have in your mind, you just have to go take the notebook and just replace with whatever instrument you like, and just you will get all the answers which you have in mind. And which sector will start to recover the first? We'll have the answer in coming slides. And silver, gold, platinum, all these things you can actually replace. So it's the same thing. For simplicity, we'll be only working with gold price, and all your questions I think are related to what we will be covering. So just hold on to that. We'll be answering all those questions. So let us understand the past pandemics. So any idea of how is this a new problem? So the answer is no. Pandemics did are with us from centuries. So from the data which we have, it's right from start, say 165th year to till date, we have a lot of pandemics in past. And this I have highlighted top three by death toll in red, and top three by death toll, bottom three by death toll in green. And there is one significant trend which is coming out from this. Can anyone point me to that trend which you can see? So these are the number of pandemics which has happened in past. The first is the name, then there is what kind of it was, and the last column is of death toll. So do you guys see any kind of trend in this pandemics or over the years? Right. So some of them are able to guess it right. So there are two trends which are emerging from this. One is there is significant fall in the number of deaths. So the Black Death pandemic was very bad, like it impacted like 200 million people, and so was the smallpox, which impacted roughly around 56 million. And over the years, like if you see the recent pandemics like swine flu, SARS, Ebola, and MERS, uh, they are still significant, but less when you compare with Black Death and smallpox. And there was like around 100 years back, there was this pandemic which impacted 50 million people. So overall, if we just ignore that Spanish flu, then overall, if you see there is a fall in the number of deaths, and also the period where this pandemic lasts is also reduced quite significantly. And the reason we all know is because now there is like improved healthcare system which is available to us, and also a lot of effort which goes in finding vaccination and other stuff, which has made this possible. Okay, so this is it. And but a lot of people question us, okay, this is vaccination and healthcare is one thing, but how contagious is coronavirus? and the impact of the death toll and infection will depend on how contagious it is. So let us quickly understand how contagious it is. So this is R0 score. So basically it says how many people it can infect. So measles was around it is on an average 16. So a person suffering from measles can infect 16 other people who are unvaccinated with the same disease. And the same for coronavirus is 2.5. So coronavirus can impact on an average 2.5 people who get in close contact with that person who is impacted with coronavirus. So if it is only 2.5, then can someone answer me, like why people say there is an exponential rise, or why do we see exponential rise in number of cases? Because it is impacting 2.5 people, right? So why there is an exponential curve in number of infected cases? So every day we see number of infected cases, like day to day change, rise exponentially. So why is that the case? So any thoughts around this? So there is human to human transmission which is happening, and it is contagious of 2.5. Okay, so some of them have given us the correct answer, so thank you for that. So I would like to draw an analogy with our investment world, which is called as compounding. So we heard a lot of things around compounding, like business compound their wealth. So similar analogy will be I'll be using it. So basically, a single person gets impacted on day one. So next day, 2.5 will be impacted, which is day two, and on the third day this 2.5 will impact or infect another 2.5 people. So on day 3 we'll see a count of around 6 people which are getting impacted. Now the 6 people will again impact 2.5 people, so the number of count which we'll see on day 4 will be say around 15. So every day, like from 1 to 2.5 to 6 to 15, so we are seeing this exponential rise in this number of cases which are reported day on day. So even 2.5, because of this compounding principle, it's actually rising quite fast. And the best way to contain this is social distancing, which is what is followed by most of the government around the world. So now we have a fair bit of understanding. Now the question is, how will this thing end? So, and basis of this, we will be able to understand the impact on financial markets. So, so the first scenario is strict measures are taken which will contain the coronavirus. So there is one analogy in our history which is SARS. So SARS was of a similar nature, and it started in southern China in 2002, and it was brought under control by the measures which we are seeing around us, which is through isolation, quarantine, and contact tracing. So in this, around 8,500 people were impacted, and there is currently no vaccine for this, but because they were able to contain this through social distancing, the number of new infections were plateaued out or flattened out, uh, and the number of deaths eventually also reduced. So, but in the early days, this was pretty scary as how it is for coronavirus, and the death rate was also very high. Uh, but the SARS was a stark differentiation because we were able to easily identify in those days of the people who are impacted by SARS. But for coronavirus, it is in some of the research report, like people with no symptoms are also are impacted by coronavirus. So it will be slightly trickier, but this measure can still be uh, applicable to coronavirus. So if we believe this is what will happen, then then these are the number of cases which are increased, like cumulative count of that along the number of days. So for example, US took 24 days to reach 100,000 count, and similarly for other countries. So what we have to do is we have to make this exponential rising curve a flat curve. So what South Korea did, so they actually made it quite flat, and similar thing was done in SARS. So this is the chart from Wikipedia. So as you can see, the orange line indicates the cumulative cases which we have, which is the same line which we see in this chart. And the number of cases were initially rising right from April to May, but because of social distancing and other measures, the number of incremental case started reducing, and which is what made in this S or a logistic curve which we see on my screen. And the death rate actually followed this orange curve, and it also flattened out. So, if we believe SARS is a good analogy of what will happen with coronavirus, then these are the timelines which we'll work out with, and let's see how financial markets played out during SARS period. So, this is the same daily percentage change of the four instruments which we are working with, which is crude, S&P 500, gold, and 20 years US Treasury bonds. So since this was pretty much a disease epidemic which was in China, so we see less impact on financial markets. But nevertheless, this red line indicates when this there was a possible health emergency which was announced, and around that there are some just sharp movements up and down or increase in volatility which we can see. So again, this chart makes it very clear. So the crude actually followed quite a lot during this period, but S&P 500, which is this orange line, was relatively less impacted of what we see in this coronavirus times, and same as this US Treasury. So again, the drawdowns were bad in the sense for S&P it was around 15% during that period, and crude was 30%, but gold was again in mid-teens, and US Treasury was also down around 5%. But since this was managed very well by containing, so there was not significant fall as we see right now. And also we just do the same correlation analysis, and in this everything is negatively correlated with S&P 500. Again, this won't be the right data points to work with because this epidemic happened in China, so better metrics would be to compare it with the Shanghai index. But then nevertheless, we are seeing a very high negative correlation between S&P and the treasury bonds, gold, and crude oil in this period of time. And let's see how the things pan out after the crisis is over. So the blue shaded region is when WHO says everything is fine, and that is when the blue period starts with. So as you can see, uh, like there was this sharp fall during this emergency declaration, but after that the index actually recovered quite sharply, and the number of days since this thing happened was also quite short, as you can see, and the recovery was also very fast in this blue period. Okay. So that is there, and so idea is so I've just taken four instruments for simplicity. If you want to do any kind of correlation analysis or on any other instrument, for example VIX, or for your own local index, then feel free to use the code which I'll be sharing with this presentation, and replace the instrument with your own favorite instrument which you want to analyze with. And hopefully if you find something interesting, then do share it with me. And so SARS was similar to what coronavirus is, like social distancing and no contact and other stuff. So So and this actually was very well handled, so it didn't spread very much away from China. It was there in some other countries, but the number of cases was not quite significant. And this is the returns which you so this is the same representation, this is same graph, but in a bar graph format. So this is 1 year, 3 months, 6 months, and 1 year returns from say 26th March, which is the first date when WHO declared emergency on SARS. So for S&P 500, the returns are very robust, like 5%, 10%, 15, and 25% for 1, 3, 6, and 1 year period. And similarly, you can see for crude CL equal to F is crude futures, GC equal to F is gold futures, and this is TLT. So this is a similar kind of analysis. And the most interesting question is which everyone was asking is which sectors will be impacted the most and how the performance of this sector will be after the crisis is over. So as you can see in this graph, the sectors which are most impacted are at the top, and sectors which has shown a positive returns or least impacted are shown at the bottom. This is of MSCI China sector performance. And as you can see, the most impacted were consumer durables, hotel, restaurants, and leisure, and airlines. So these are some of the sectors which are most impacted, and some of them which are least impacted are healthcare, food, beverage, and tobacco. People like to smoke even during crisis, and other sectors. So this dark blue indicates the performance of the sector during the crisis, and the light blue indicates the performance of the sector after the crisis, after this epidemic is over. So as you can see, this food beverage not only had a positive return during the crisis, but after the epidemic also, it has shown the most positive performance after the crisis. So this gives us some cues like the products which are in FMCG or of daily essentials are something which we can look for. And similarly, healthcare and pharma companies are showing similar trend. And something like retailing was say negative during the epidemic and also after the epidemic. So for some sector, we are able to see a prominent trend from this analysis. So if we go by SARS and if we expect something similar to turn out in COVID, then you know which sectors will be showing the healthy performance during the recovery phase. Okay, so that was scenario one, which is we are able to contain by say strong measures. Any queries or any like observations so far? So there is one observation which says the energy sector was less impacted during this, and then afterwards happened in the negative zone. So yeah, it's actually quite surprising, and maybe we can consider this as an outlier, because whenever there is so the theory is whenever there is pandemic which results in economic slowdown, and economic slowdown results in less demand for crude and eventually a fall in crude prices. Okay, so thank you for all the observations. So let's move to the second scenario, which is what will happen if this spreads widely. So widely is most of us which are living on this earth gets impacted by this virus. So something similar happened in past also. So if you guys are aware, so there was a Spanish flu during World War One, which is during 1918 to 1920. So the world population was around 1.8 billion at that particular point in time, and the Spanish flu infected around 1 billion of the people on the world, which is around 56% of the population, and the death toll was around 50 million, which is around 2.8% if you consider in terms of percentage terms. So this was very severe in terms of the death toll, and therefore it is rated the highest, which is 5. And the reproduction rate was less than what we have for coronavirus, which is 2.5, and for Spanish flu it is 1.8. And the other two, which we also seen in last 100 years, was Asian flu and Hong Kong flu. So both of this impacted around 500,000 of the population, which is mid-teens in percentage terms, which is 17 and 14% respectively. And the death rate was low when compared to Spanish flu, which is 0.1%. So around 1 to 4 million people died because of this flu, which is very significant, but less compared to Spanish flu. And the fourth was swine flu, which just happened 10 years back. So on a population of 6.8 billion, it impacted around 11 to 21% of them, which is around zero point 0.7 to 1.4 billion of them. And the death rate was very, very low in this case, which is 0.2, which is 0.03. So I just given the numbers for coronavirus. So this numbers might not be most recent, but it can help understand how much, what level the crisis or this disease has reached. So for coronavirus, it has impacted roughly around 1 million of the people, and the death rate is around 48,000. So if we are able to say like or create a scenario where this will be impacting a lot of people. So for example, like a swine flu, which impacted around 11 to 21% of the people. So let us draw analogy with that and let's understand the same financial impact during that period. So it was same pandemic which was declared by WHO, and the fatality rate on in the initial period was very high. So it killed around 12,500 people in US in the first year, and in fact infected 60 million of the people. But eventually it was very low, the mortality rate. Uh, so this was the timelines of how the swine flu played out. So I think the initial steps we are aware of because similar thing is happening in coronavirus. So the first case is found, then WHO declares a public health emergency, then a pandemic is declared, and then there are like a lot of cases, rise in cases. Then the clinical trials for the vaccine begins. Then FDA, which is like the US in a body in US, which approves the drug, uh, approves some vaccine for the swine flu, and then it starts gives the permission for production, and finally vaccine reaches to everyone, and then WHO declares, okay, now this is the end of this pandemic. So this is how this has played out, and if you just map it to how the financial markets actually reacted. So the blue line is when the first was impacted, and the red line is when WHO declared emergency. So you will see a stark difference to what is seen currently in the markets. So currently in the markets are very less volatile, or between say 0 to say 2%, and suddenly because of coronavirus the range has become from 5 to 10%. But this you see some completely different, and the reason for that is the during this period, which is 2009, the financial markets were recovering from the 2008 financial crisis, and the stocks were significantly undervalued during that particular period in time. So therefore, the movements were not very like sharp, which we are seeing currently. But nevertheless, as you can see, when the pandemic was declared, there was this fall in crude oil, which you can see on my screen just after this red line, and also gold, S&P 500, and only the TLT was rising, and the reason was that same, like Fed has this lowered the interest rate to support the economy. So these are the drawdowns which we see. So S&P 500 had a 6% drawdown initially after the pandemic was declared. Crude was down around 18%, gold around 7%, and TLT in range of say 13% it was down. Eventually, there was like this happened in say multiple waves. So initially it was not that severe. Then later on, it started spreading to a lot of people in US. So therefore, we see a lot of fall not right when the pandemic was declared, but sometime later when it actually started spreading quite a lot. So therefore, these are the falls. So the S&P, the most maximum drawdown was around 16% during this time period. And now with this data points of swine flu, now we are able to establish some kind of clear relationship. So the relationship between S&P 500 and TLT is negative, in the sense if S&P will fall, then TLT will rise. The relationship with gold is still not clear, so we don't know whether gold is a safe haven or not, because you can see this blue dots are around this chart. And with crude oil, we are seeing this positive relationship. So if S&P falls, which is an indication like economy is not going to do well, and so is there will be a fall on crude oil prices. So positive with crude, negative with TLT, and no relationship with gold. And let's see how things turned out after this. WHO said everything is good, no more swine flu. So as we can see, the returns are pretty strong, which is highlighted in this blue area. And the code for everything is available in a GitHub, so you can try out with all your favorite stocks. So S&P 500, like if we calculate the returns from say this very first date to say a year after WHO declared everything is fine, is around 42%. For crude is magnificent, which is 73%. Gold is 30%, and TLT is minus 10%. So indeed, when everything gets sorted out, market gets into their own bullish mode, and everything looks perfectly normal. And these are the same things, but in a bar graph format. So these are returns like 1 month, 3 months, 6 months, and 1 year from now. So crude was the leader in this phase, and even S&P 500 was the second best during this time period. So these returns are from 25th April, when WHO declared emergency for swine flu. And those are the various sector performance. So again, we see financial on the other end of the spectrum. So when we actually compared with coronavirus, financials were at the bottom, but in this case it is at the top. And the reason for that is in 2008 there was like significant selling which happened in this financial markets, financial stocks, and they were significantly undervalued. So even though there was this scare of swine flu, the financials were able to pick up pace and perform relatively better compared to others. The same thing is happening for technology stocks. They are less impacted in current market scenario, and they were less impacted even during the swine flu time. And another thing is which you are seeing is energy sector, which is impacted because and again it started to rise. So this is primarily driven by the crude market rally which we had seen during that particular period in time. So energy was able to catch up pace. So so yeah, so there is a stark contrast which you see. The returns are very strong in this period. So primarily because during the financial markets crisis, which played out in 2008, there was like significant downfall in the equity market, and therefore this looked less what we can say less impacting compared to the financial market crisis. So now let us look at the other two, which we talked about was Asian flu and Hong Kong flu. So this is the performance of S&P 500, and the red line is when it started spreading to US. So as soon as it started spreading to US, the market started falling, what we are currently seeing. But once there was clarity of how this going to deal with, the market again started to rally. This green line indicates where everything started becoming normal, and this blue area is after everything was normal, how the performance was. So the same story is repeated across say in Asian flu. So the maximum drawdown is around 20%, right from when the WHO declared emergency. And similar thing played out like a V-shaped kind of graph again in Hong Kong flu. So Hong Kong flu started falling when the emergency was declared, which is this red line. The maximum drawdown was around 35%, which is what S&P 500 drawdown currently is. And but once things were normal, things we know how we want to deal with this. It actually the recovery was very fast, very steep, and the returns also during that period in time. So this is if even if it spreads to say 500,000 of the people, but if we get some kind of direction of how we are going to deal with it, then market will start recovering. So one thing which is coming out very stark from all these graphs is market does not like uncertainty. So if I don't know what will happen with coronavirus, so market does not know, so it will keep on falling. But once we get the direction, okay, these are my priorities, this is how I'm going to deal with this, market starts to factoring, okay, this is where the crisis will end, and that is how the stock market starts to react to those kind of news. Now, going to the top of the pandemic, which is Spanish flu, which infected around half of the population during that particular point in time, and had a fatality rate of 3%, which is 2.8%. So the Spanish flu played out in three different waves. So initially in say June and July of 1918, then in October to December of 1918, and then in Jan-Feb March of 1919. So there were three waves during which it played out. So let's see how was the performance during that particular time. So I just taken Dow Jones to understand the impact of this, because S&P was created in 1927 as a 90 stock index, and later on as a 500 stock index. So we don't have a data for S&P 500, so that's why I replaced with Dow Jones. So as you can see, when there was this first, which is around June, July of 1919, the market are going up even during the worst wave of this swine flu, which is in October to January. There was this fall from 85 to 80, but it actually recovered quite sharply from there. And again, the same reason of what we seen in swine flu. So there was a bigger event which was playing out during that particular point in time. So in Spanish flu, it was World War One. So World War One had a far larger impact on the market, which was already factored in. So the impact of Spanish flu is not really seen during this particular time period. So what we can do is we can take at World War Two. So this is actually very extreme comparison on my end, but again, no harm in comparing how things will come out. So during World War Two, around 75 million of people died during World War Two. It lasted from 1939 to 1945, and again, I just wanted to highlight the story is the same, the V-shaped recovery which we are seeing. The only difference is in the timing. So some are taking more time, some are taking less time, and this is driven by the impact of how the things will be. So this is again a V-shaped recovery which we are seeing. And someone would ask or have this question: so World War ended in 1945. So why did markets started rising from say 1942 onwards? So any guess on that? Anyone? So I'm just repeating the question again. So World War ended in 1945, which is a known fact to every one of us. But why did markets started rising from 1942 onwards? Right. So some of them actually gave the very correct and accurate answer. So during 1942 or mid of 1942, the Allied forces, as someone rightly pointed out, were very clear. Okay, Germany is the enemy, and that is what we are going to fight. All my resources will be channelized to fight Germany. So there is a lot of certainty, there is a lot of clarity, and there is a lot of know of how the things will play out. So market starts to factoring all those probability, and if the probabilities of a particular event becomes very high, so it starts factoring in the prices, and therefore the prices starts to rise much before the world war ends. So that is how the stock market is. So these are the drawdowns. So drawdowns are around 43%, which we can see during World War II. So to summarize, whatever we have discussed is, so we discussed World War II. So the drawdown was 43%. Hong Kong flu, which was again a drawdown of 36%. COVID stands at third place with a drawdown of 33%. Asian flu, again, all this are in mid-teens, or Asian flu at 20%. The returns after, say, a year are quite promising in the sense, just forget this World War II, because World War II actually played out for many, many years. But apart from that, if you consider the recent pandemics such as SARS, Ebola, swine flu, Asian flu, the returns are very promising when you consider 6 months, a year period. And for World War II, if you consider a period of 4 years, then again they are very promising returns, which you can see. So maybe this can give you some idea of how the returns will look like 6 months or a year for COVID-19. So now, for now, we just talk about a lot of like how the S&P 500 perform, what were the sector performance. But now the most interesting part, which everyone would be thinking of, is what kind of strategies work in the market, or how the strategies would have worked in the past pandemics, right? So it's more interest which we have, right? So one of the key ways in which people have started investing is through factors. So factors are basically a known source of return. For example, momentum is one of the factor, which simply says if anything rises for a year, then it will continue to rise. And similarly, there are different factors. So let us understand the performance of this factor during COVID-19. So as you can see, I have just plotted, created a table which is showing you the monthly performance of different factors. So the first is low volatility factor, which is investing in stocks with low volatility, which is typically beta less than 1. Second is momentum factor. Third is high dividend or value factor. Fourth is the small cap factor. Small cap factor is investing in small cap companies. These are driven by market capitalization. So, and the last is the overall market returns. So the overall market returns is minus 19% during this 3 months. But one trend which is coming out is momentum on a relative basis has outperformed the market, and so is low volatility strategy. But the high dividend, which is the value investing, and small cap has underperformed the broader market. So, so the question which we all have is, will momentum and low volatility continue to outperform in this? So that is one question to all of you. And the second is, will small cap stocks are good to invest, or will they never recover, and we'll see like more fall in this markets? So, so there is one question which says, what is momentum? So, momentum is something which rises will continue to rise. So, for example, if a stock rises for say a period of 12 months, then for the next 1 month we can continue. We can expect that the stock will continue to rise. So we go long on that particular stock. So that is momentum factor. Okay. So my question is, will momentum and low volatility continue to outperform? So what do you think? Okay, so it's very difficult to answer just like this. So let's look at how the things would have played out in past pandemics. So we'll again compare with World War I and Spanish flu. So the same trend which is seen again out here. So the markets are highlighted in this black color, and the momentum is in this gray color. So as you can see, it's almost close to market or slightly above the market, and the small caps are very much below this black line, which is indicating underperformance during this correction phase. But what has happened during the recovery phases, the small cap has outperformed the markets and all other kind of investing, and the momentum and low volatility stock during the recovery phase have underperformed the market. So This is during Spanish flu and World War One. And let us so the number of pandemics which has happened in say last 100 years are very few. So we'll also consider various market correction which happened say in past, which is from 1873 to 1918, which is pre 1926 period. So there were a lot of panics which also happened, not necessarily pandemics, but many things like banking crisis of 1907 and something of that sort. So again, the same trend is repeated here, which is market is falling around 20 to 25%. Low vol and momentum are not falling by the same amount during the correction phase, and in the recovery also is not that much in the low volatility and momentum. But the small cap are falling more during correction and also are rising more in the recovery phase. And low volatility plus is the combination of momentum and low volatility factor, which you can see. So basically now this is how we know the factors played out. Next question is how long will this last, or how long will this play out? So going by the past, so as we have seen, the number of days have reduced from previous pandemics to the recent pandemics. So swine flu, everything played out between 116 days, and SARS between 101 days. But it's very difficult to predict this kind of situation. But if we go by this, so I think everything should play out within 3 to 6 weeks of time. And the most important disclaimer for this kind of thing is the importance of social distancing. So if government everywhere across the world are very proactive in imposing social distancing, so this is the chart which you can see is from 1918 Spanish flu time, and these are for the various cities in America. So for various things, so the skin color bar graph or the brown color bar graph shows the number of days for which the lockdown was imposed. So the cities where the lockdown was imposed multiple times and for a longer duration of time, the number of death toll was very low, and they were able to quickly recover from this Spanish flu and had a very less impact on their economies, or maybe economic activity, which we can say. So if we are able to follow a similar thing, then might be we might be able to weather this crisis, weather this epidemic very fast. And going from all this presentation cues, so how to protect this? So one way is you can say have TLT in your portfolio, because it has a negative correlation with S&P 500. So if you have a equity dominated portfolio, then it's better to go with TLT. And second is you can have multi exposure to multi-factor portfolio in your existing portfolio to reduce the impact. And which factors to go with, it's again your call. It's again your call based on what you think currently is correction or recovery phase. Based on that, you can allocate the factors in your portfolio. And again, I'll recommend you to avoid crude oil, because if this stays for long, then recession is what is forecasted for this year, and which will mean less demand for crude oil, and the price will continue to fall. So that is how it is. And these are some interesting charts. If you like, you can have a look of how the past crises have played out, and what was the impact of that. And these are some sources and references which I have used in this presentation. I hope you like this, and I am opening the floor for Q&A. So Aditya, you can take over from here, and I'll be very happy to take the questions from class participants.
All right, wonderful. I hope I'm audible right now.
Yes.
All right, wonderful. So thank you so much, Ishan, for presenting such a wonderful analysis of the pandemics that have affected, or if the right word should be plagued, our financial markets in the past. And I'm sure that the audience today got a lot of insightful and actionable information to consider and absorb for the coming days. And right, as you can see on the screen, actually there are a lot of
questions that are coming in, and the first one is that won't gold suffer sharp declines when institutional investors sell them to cover their margin calls? Ishan, what would be your answer for that?
Yeah, that's a very good question, Utkarsh. So, yeah, gold will have that kind of thing. So, basically, if institution or a lot of people will be losing out jobs, and gold being the uh, like supporter of the last resort, they will sell gold to bring in some cash and support their operations. So that is pretty much what we think and what should happen. But if you take cues from past pandemics, we are not able to find any kind of patterns with respect to gold. So it was, as you have seen in the graph, it was all around. So it was, we could not establish any kind of pattern with, say, S&P 500 or with, say, bond yield.
All right. Thank you so much, Ishan. Mustafa is asking a question which is regarding Quantra courses. He's asking if he's going for Forex and crypto courses, would Python be the effective way to define algos?
Yes, so Python is a pretty good language. So all the charts which you have seen in this presentation are created in Python. And the good part about Python is there is a lot of community support which is there. So all the packages, right from machine learning to very basic package like how to fetch the data and all the stuff is easily available in Python. And algo trading requires you to get the right set of data, generate signals, and send the orders to your broker. So Python will be very friendly and helpful language if you are looking to automate your crypto and FX strategies.
All right. All right. Okay. And because we had so much focus on the gold markets today, someone is asking, should an individual invest in gold at a time? Now, that is a very subjective answer, but what would be your view, Ishan?
Yeah, again, so it's again your call, but I'll just like to highlight again is there is no correlation which is seen with gold and other asset classes. So that will be like an independent view which you can form on the gold and then invest on basis of that. But generally, if you are looking to actually invest your money in some asset class such as gold, it's better to diversify it and invest in a portfolio of multiple asset classes. So in times when gold is underperforming, your other components of the portfolio will help you to manage it. So always think from a portfolio perspective. Thank you.
All right, all right. Thank you. And we are getting a lot of questions, but as I promised the audience that we will finish in the time span as promised, I would request everyone to, after the webinar, you can send us your questions on our email ID, and we would be more than happy to answer to all of them individually to all of you. Thank you so much, Ishan, again for taking out the time and having this wonderful presentation for us. Yes, thank you so much, Ishan.
And yeah, thank you, and thank you everyone, and do take good care of yourself and your family. These are like interesting and difficult times for us, and most of you wouldn't have seen any such in past. So I request you to all, please do take good care of you and your family, and take care. Thank you.
Yes, thank you. Thank you so much, Ishan. For the audience, I would like to remind you that for the questions, you can ask your questions on our community page, which you can access through our website. And the link would be forwarded to you through the chat box. And the community is an excellent place to get your doubts resolved. And actually all the experts would also be able to help you that way. So yes, as you must have known, my pet dialogue for the webinar goes, I would like to thank everyone and Mr. Ishan for coming together and making this webinar a success. And yes, so with this, I would take your leave and hope that all of you will stay safe and keep learning. Thank you everyone.